retail participation in the stock market has reached its highest level in years. This surge has been defined by rapid speculative behavior, driving prices to record highs even as underlying economic indicators begin to soften. Warren Buffett has navigated these cycles for over half a century. Since 1965, Berkshire Hathaway has averaged 20% annual returns, consistently doubling the S&P 500 and establishing the gold standard for long-term performance benchmarks. However, Buffett's recent actions suggest a significant change in outlook. For 14 consecutive quarters, the longest stretch in the company's history, Berkshire Hathaway has been a net seller of stocks. This sustained selling has resulted in a cash pile totaling $397 billion. Today, more than one-third of Berkshire's total assets are held in cash and short-term treasuries, rather than in the stock market. We can track these movements through Berkshire's latest 13F filing. This regulatory document provides a factual record of every trade made by the firm, allowing us to see exactly where Buffett and his team are finding value and where they see growing risk. For an investor known for his buy and hold forever philosophy, this accumulation of capital is significant. Buffett is effectively opting out of the current market, waiting for prices to align with his strict requirements for safety and value. The latest filing confirms a broad exit from several major industries. Berkshire sold its entire stake in Amazon, United Health, and Domino's Pizza. They also liquidated positions in Visa and MasterCard, while significantly reducing holdings in Bank of America and Chevron. To understand this retreat, we have to look at a metric known as the Buffett indicator. It is a straightforward tool used to determine if the entire market is overvalued relative to the real economy. This indicator calculates the total value of the U.S. stock market divided by the nation's GDP. Historically, the market tends to fluctuate around this historical trend line, reflecting the actual output of the economy. Today, that line has reached a level 2 standard deviations above the mean. By this measure, stock prices are currently high relative to the actual economic activity they represent, making them more vulnerable to a downward adjustment. This overvaluation is occurring alongside rising concerns regarding inflation. Buffett has specifically pointed to the long-term risks associated with massive government debt and the potential for a weakening dollar. Buffett notes that the United States is not immune to the effects of runaway inflation. If the dollar's purchasing power begins to erode too quickly, it complicates the ability for any business to generate real, inflation-adjusted returns for its shareholders. When valuations are historically high and the underlying currency is under pressure, the market's stability decreases. In this environment, unexpected global events can cause price movements that are much more severe than they would be in a more reasonably priced market. Despite the overall selling, the filing reveals a few concentrated purchases. Berkshire added $10 billion to its stake in Alphabet, making Google's parent company their second-largest technology holding after Apple. They also entered a new position in Delta Airlines. While Buffett has historically avoided airlines, Delta recently reported over $1 billion in free cash flow, outperforming its competitors even as fuel costs rose across the industry. The common factor in these trades is a concept Buffett calls an economic moat. It is the single most important characteristic he looks for when deploying capital in a volatile economy. An economic moat is a structural advantage that protects a company from competition. These businesses possess enough brand power or technological dominance to raise prices as their own costs rise, effectively maintaining their profit margins. Google's moat is built on its infrastructure and brand, while Delta has emerged as a top operator in one of the world's most difficult industries. Both companies have the cash flow to withstand economic pressure that would bankrupt smaller competitors. Buffett is concentrating his remaining market exposure into these specific areas. He is selecting businesses that can pass the costs of inflation directly to the consumer, providing a level of protection that cash alone cannot offer. For the individual investor, the goal is not to mirror Buffett's move into cash. Liquidating a portfolio entirely is a timing exercise that rarely works for smaller accounts, which operate under very different constraints than a massive conglomerate. Berkshire Hathaway is like an aircraft carrier. Because of its size, its trades must turn very slowly to avoid disrupting the entire market. Individual investors are more like speedboats. We have the agility to take advantage of small opportunities that Berkshire is simply too large to consider. We can apply Buffett's principles through 3 specific rules. First, audit your holdings for economic moats. Focus on companies that provide a service or product so essential that their customers will stay even if prices go up. Second, prioritize fundamental value over speculative growth. In an expensive market, companies with durable cash flow and proven profitability are far more likely to recover quickly from a downturn. Third, use your income to invest consistently through volatility. Downturns should be viewed as an opportunity to acquire high-quality businesses at prices that were unavailable during periods of market euphoria. High market valuations often mask underlying risks, but they do not stop the process of compounding wealth. By focusing on businesses with strong moats and maintaining a long-term perspective, you can navigate periods of instability and emerge with a more resilient portfolio.